Hey, everybody. Welcome to January 19th's MakerDAO community call. My name is David Utrobin. I am a community development lead here at Maker, and I have the good pleasure of hosting this call every Tuesday. And so if you're new to the community call, this is a call that's a little bit less, I would say, like official, like formal, dealing with like official MakerDAO governance business, like for example, the Thursday governance and risk call, and more about informing people in the community about what's going on through the weeks where we go over Maker Relay, and also to kind of surface interesting things that are happening with Dai, with the Maker Protocol, with various integrations. And so we aim to have interesting guests on this call as well. And so yeah, definitely tune in anytime you see a title of a community call you like, an interesting guest you might want to look into, because these calls are really meant for you, for the community. And so today we're going to be having on, and I'm going to try not to butcher your last name, Allan, but we're going to have Allan Niemerg on from the Yield protocol. And so Yield is actually really interesting. They are creating fixed rate, fixed term borrowing products that use Dai in the backend. And actually, I'm very curious how it uses the Maker protocol itself in the backend, if at all, because I know that there's a really interesting mechanic going on with the FY Dai thing. But details aside, we're going to invite Allan on the screen, and we're going to get into it. So give me just a second. All right, cool. And then while he's joining, just a brief kind of like notice. Feel free to ask questions in the chat. I'm happy to relay them for you on your behalf. Also, if you're interested in actually like coming on the mic or on video, ask in the chat. I'm happy to invite you on as well for a bit more like face-to-face discussion. And so yeah, with that, don't be shy. And yeah, hey Allan, welcome to the community call.
Hi David, thanks for having me. And thanks for the community for joining in, everybody coming in and checking us out today. As David said, I'm Allan. You said it right. It's Niemerg, and I'm the founder of the Yield Protocol. We launched our version 1 in October of last fall, and now we've just been out trying to make it better, trying to improve it. And one of the reasons I asked David, and I think one of the reasons he had me on the call, is because we created a new tool with the Yield protocol to make it easier for Maker borrowers to lock in a fixed rate. And I hope to show that today, and also explain and answer your question, David, about how does Yield protocol work and how does it interact with Maker. So with that, I guess we can begin. Mind if I share my screen?
Go for it. It's all yours.
Oh, okay. I see how to do that now. Okay. Let me just.
While that gets pulled up, I'd love to hear the story about what drove. What you personally. What was your personal path to like getting involved in the space and actually like going after creating something like a financial protocol?
Sure. So I guess I'm kind of been in the crypto community for a while. I remember I started buying Bitcoin like back in 2011, and sadly didn't hold on to all of it. But I've really been sort of fascinated with crypto for a while. Just have enjoyed working on different things, and so I guess my path to what I'm working on is sort of like many people. You kind of go down lots of different roads and kind of end up where you are. For me, what was formative for me was I worked at a trading desk called Cumberland during like the last crazy Bitcoin and Ethereum boom, and we had challenges where as a part of just trading day to day, you would need access to capital or to various cryptocurrencies, and so that sort of got me thinking about like how the borrowing and lending market worked in crypto. And so I started playing around with it. I started playing with Maker. I liked Maker. And I've kind of watched Maker since it was formed. I think one thing that really stuck out to me, or a few years ago, I think in like early 2019, I had a CDP I had borrowed some Dai, and just it felt like overnight I saw the interest rate on the stability fee, excuse me, and Maker just go up fast. I mean, I think it hit like 20% at one point.
Yeah, I remember that vividly.
And it really sort of stuck with me. It's like that's like it's like that's a lot of interest to pay, and it would be really nice if you could just lock in a fixed rate loan, and and if there was a good market for that, because hey, everyone would want that kind of certainty. So it really started getting me thinking about the problem and exploring solutions. And so I started working. I started hacking on some stuff. But really, what sort of kicked off Yield Protocol was actually originally Dan Robinson, a research partner at Paradigm, published a paper.
Yeah, I remember reading that paper.
He published a paper called the Yield Protocol a year and a half ago, I think, or something like that. And I was really taken by it. I'm like, okay, this sort of crystallized a lot of the things I was kind of working on and thinking about. So I reached out to him. I was like, hey, what do you think about this? And what do you think about that? And like building and bugging him about it. And he's like, finally, just like, you know what, just need to build this. Let's work on this together. And so we started working on Yield Protocol. Paradigm invested, and we built it and launched version 1. And the goal of version 1 was to be it's relatively simple. As DeFi apps go. I mean, there's no governance, there's no token. We don't have any admin keys. We built this protocol. We literally just launched it into the ecosystem, and it just exists. Like we can't, it's immutable. We can't change it. But it was designed to sort of, as a version 1, to sort of live for a limited time. So it basically, by its own nature, will expire, roughly at the end of this year. And but what it lets you do is it lets you put up ETH and borrow Dai at a fixed rate. And I'd like to talk a little bit about how it does that. So the key aspect of that is, and I have my screen up now, so let me just put up some slides here. Move forward one.
Also, I posted that paper that was by you and Dan in the chat if anybody is interested.
Yeah, thank you. And if anybody has any questions while I'm talking, please, throw them in the chat. I can see it. I'm happy to answer. Okay, so what you have on the screen here is like the basics of what Yield Protocol does, and what very simplified. And what you do is, to borrow at a fixed rate in Yield Protocol, what you're doing is you're putting in your collateral, and we really only accept ETH collateral at this time for version 1. And then you mint a new token called FIDOT. So it's kind of like Maker, where you put in ETH collateral, and then you mint Dai, right? You put up your collateral, you mint Dai, and it's collateralized, and you have some collateralization ratio. Same thing here. With the FIDAI sort of being in the same situation as Dai. You can mint these FIDAI, and these FIDAI have a maturity date. So at some future date, depending on what we call a series of that FIDAI, so there's multiple series of FIDAI, that FIDAI can be redeemed for Dai. So as you can see in this wonderful little graphic, at some future date, your FIDAI can be exchanged for Dai, and 1-to-1. So if you have 10 FIDAI, you get 10 Dai. And the benefit of this approach is that that this FIDAI basically acts as a zero coupon bond, and you can sell it in the marketplace, and the person buying it will know that, okay, I'm going to earn so much Dai in the future. I'm willing to pay this amount of price, and that price that they're willing to pay implies an interest rate. Mm-hmm. So when you sell the FIDAI, effectively what you're doing is you're locking in a fixed term loan. So let's look at that in too many clicks. Let's look at that in a little bit of detail here. So you come along, you can deposit your ETH collateral with the Yield Protocol. You mint the FIDAI. You sell that FIDAI, locking in a fixed rate. The buyer of that on the other side, though, is buying the FIDAI, and by holding the FIDAI, they're a lender. and they're locking in a fixed rate of return. So there's two sides to this, and then after maturity, so after that future date arrives, you come along and you pay back the DAI that you owe, and then you can unlock your collateral. And this is also where there's a little bit of Maker integration that I think is interesting, that we can talk about. Well, let's talk about it now. So
yeah. So actually, hold on. I do have one quick question. So
sure.
it sounds like FiDai, like this whole mechanism is outside of the Maker protocol, and so this fixed rate is actually being earned not by the Maker protocol but by FiDai purchasers, correct?
That's right. That's right.
Okay.
The fixed rate of return. I mean, the protocol actually doesn't have any fees. Actually, currently version 1 doesn't have any fees, and in fact, it doesn't itself make any money. The interest paid by the borrowers is actually paid to the lenders.
Got it.
So whoever's in that lender seat is the one earning that interest.
Got it. So effectively, this is a secondary borrowing market for DAI. Yeah, cool.
That's right. And the key thing actually hit is, at least with respect to Maker. I mean, the yield protocol is built on Maker, and let me tell you why. So we have this little issue here that may not be clear, when you first look at it, but it is sort of a problem for our protocol, for yield protocol. That is, users have put up ETH collateral, and they've borrowed, or they owe DAI, right? And they owe DAI to the lenders. So after the maturity date occurs, these lenders want their DAI back, but the protocol doesn't have any DAI. All it has is the borrower's ETH. So, I mean, what you could do, an easy solution is, well, you could just sell the ETH that's in the protocol, and get DAI, and then give the DAI to the lenders, when they show up. I mean, you could do that, but it would be really frustrating, I think, to borrowers, because they don't really want their ETH collateral sold. That's,
right.
That would be very strange, so they would prefer to keep their ETH. I mean, I think they want to be able to come back and get their ETH. So what we do is we just sort of square this in a very simple way. We take the collateral we're given by our borrowers, we put it into a Maker Vault, and then we borrow DAI against it. And so when lenders return to collect their DAI, we have it. We just borrow it from Maker. And so Maker just becomes a settlement layer, basically, for our protocol. It becomes a very easy way to get DAI, and pay off the lenders at the end. So there's some consequences of that. For example, after we reach maturity date, so after you've borrowed, say you've borrowed to December 2021, when December 2021 is reached, after that, the yield protocol is going to charge that borrower the stability fee, just as if they were in Maker, from that day on. I mean, so we don't actually, we're not going to ever sell your ETH. It basically, what we do is, after the maturity date, we sort of turn your position from a yield position into a Maker position in our system.
That makes sense.
And likewise with the lenders, if you're a lender, and you're holding the FiDai, you don't have to come and redeem it at any particular time. You can take your time and do that. And the system actually pays you the DAI savings rate. Now that's 0% right now, so it's not very exciting. But
yeah,
if it were 2 or 3%, it might be really useful for users, because you don't have to necessarily show up and redeem that right away. You could wait and earn that DSR. So that's sort of like the high level basics of the protocol in terms of how it operates. And just to kind of give everybody a little bit more intuition about what it means to imply a yield. There's a wonderful yield and maturity formula you can look up on, like how do you actually figure out what's your interest rate. This is well known, sort of primitive out there, our formula, that lots of people learn in finance, but if you're not aware of it, it's very simple. FiDai are zero coupon bonds. You can take the price you receive figure out an interest rate, or conversely, you can take an interest rate and figure out a price of the bond on any given date. And we actually used this formula as the sort of starting point to solve a problem I haven't really addressed yet, which is maybe I'll just skip right to it. How do you actually trade the FIDAI, right?
Right.
So you could go. It's like Uniswap, and this is sort of hopping ahead of myself, but you could go to Uniswap and you could trade your FIDAI for DAI in theory. And that would work. They're both ERC20 assets. You could trade them against each other. But we actually went a step further, and we created a whole new market that we call the constant power sum. And so this just sort of takes advantage of what we've, I guess, what the community and people have learned about how to build markets like Uniswap, and apply it to this case where you have an asset like FIDAI. And so instead of trading at a price like Uniswap does, we've created a market that trades at an interest rate. And this has a cool property in the sense that if you just use Uniswap and you put FIDAI and DAI into it, you have this problem that the FIDAI changes in price every day, and because it's earning interest. Right. And so as it earns interest, arbitrageurs will naturally come and trade with the protocol. Well, when they do that, the liquidity providers lose a little bit of money for every trade, right, that moves the price up. So, that's not great, and in fact, when we were starting out, people are like, oh, you can't even do this. This won't work because, when you put this in Uniswap, the LPs are just going to lose money constantly. Yep. And you have to make that up somehow. And, we were really worried about it, but we discovered that, actually what we can do is we can just build a market where you trade an interest rate space. And that's what this does. And we have a whole paper on how this is constructed and how it comes to be. But from a user's perspective, you don't even have to know about it at all. All you know is that, I'm borrowing at this interest rate, or I'm lending at that interest rate. And it makes it really simple. So how about I dive in and do a demo?
Yeah, let's do it.
Okay, great.
While you set it up, there was one question from Peyton. He asked what happens if your ETH drops in value before the maturity. So basically a question about liquidations and settlements like that.
Right. So if just like in Maker, there's a collateralization ratio. In fact, it's the same collateralization ratio. We use Maker's collateralization ratio for ETH A. So if the ETH price drops sufficiently, yes, you can be liquidated. And just like Maker, we take the collateral, we send it to an auction, and keepers or whatever can buy that collateral at auction, and then close out that debt. So it's very much the same kind of mechanism. We even tried to use Maker's auction system, but it turns out you would need permission to do it, so we had to build our own.
Yeah. Plus, our auctions are being replaced soon. Liquidation 6.0 incoming. But yeah, cool. All right, sweet.
So I'm here at the Yield homepage, where we have a nice space astronaut farmer, and we have various links to our audit, our socials, our papers, the white paper, and then the yield space paper that describes our market, and then of course the app. So let me just go to the app. Okay, here we are, and let me just make sure. Okay, I'm on mainnet right now. Okay, so just to kind of give an overview of the app, we have basically 3 actions you can take in the system. You can borrow, obviously. You can so you can borrow DAI at a fixed rate. You can lend DAI at a fixed rate. Or you can provide liquidity to our liquidity pool, and that's the market that we created. Right. And like most markets, you earn fees from trades. So basically, the liquidity providers are taking the other side. If somebody comes along, if somebody's borrowing, they're a lender. If somebody's lending, they're a borrower.
Would the pool be FY DAI series to DAI and like multiple pools of those?
Yeah, there's multiple pools. So I'll just show you. Like I'm here on the pool page. And then I can click here and I can just see the different series. So these are the different maturity dates that are out there, and we have maturity dates out till December 21st, or excuse me, 2021. And then after that, I think we'll have a version 2 or whatever.
So the pools are like primarily for the secondary market of FY Dai traders, right? If a person was to just lend and like acquire FY Dai tokens, what's the trade-off between like holding those FI Dai tokens and just earning that fixed interest rate versus like providing it to the pool? Would they? I'm just curious about your view on the different options.
You're right. There's an option there, right? Like I can go and lend at a fixed rate here, or I can go put that Dai maybe into the pool and earn fees.
Mm-hmm.
The difference is this. The lender you're gonna lock in a fixed rate. So you're gonna know that you're gonna make so much at a certain rate of interest for a certain period of time, right, until that's over, that maturity is over. For the pool users, it's not as guaranteed in the sense that the website is app.yield. That is, by the way.
I'll throw that link in chat.
Never
mind, Alan got it.
I got
too quick, man. All right.
Yeah. So I was answering the difference between lending and pooling. And pool providers are earning the fees. So the returns you get in the pool are based on the amount of trading volume that's done, and so it sort of depends. We haven't yet built a good tool, and we're working on how to best do this and think about how to make it better. So it's harder to know exactly how much returns you'll get in the pool, but they're based on the fees. We're actually currently thinking about how we can even make the pools even better. So we might soon do a version 2 of the pools
nice.
that will like better use capital. I mean, one of the things is we've like learned a lot in doing the process so far, and we're just like, okay, maybe we should roll that back in and make these pools even better. I
have one more question about the pool. So when a person deposits into the pool, they deposit in specifically just Dai. They don't deposit FY Dai, right? And when they deposit Dai, based on the interest rate, based like whatever formula that you use instead of Uniswap's constant product formula, that allows a deterministic exchange rate for FI Dai to Dai based on the series, how far along it is in the timeline of that series, and then it just enables basically a slippage-less swap between Dai and the FI Dai, right? Is that the idea?
Actually, that's not how it works.
Okay.
Although that's a really good way for it to work, and we're thinking about actually moving to that approach. The current approach is the yield protocol actually lets you borrow FI Dai with Dai. Actually, okay. We have behind this. We haven't like made this a user interface feature that directly, but one of the things is you can put ETH in and borrow FI Dai. You can actually put Dai in and borrow FI Dai. And so when you provide liquidity, behind the scenes, what we actually do is we take some of the Dai you've provided, and then we borrow FI Dai against it. And so then you are like in Uniswap, you're adding both assets to the pool. You're just borrowing the FI Dai part of the asset. We did that way rather than the way you described, which I would characterize the way you described as a buy and provide liquidity. We did a borrow and provide liquidity. And the reason we did it that way was actually, if there's nothing to buy currently, right, then you can't actually provide any liquidity. So we were very concerned that users couldn't actually put any funds into the system if we went with that first approach. And so for launch, we chose the approach of, okay, you're just going to borrow the FI Dai and put it in the system. However, it's actually probably more useful for most people to just buy it. That is the system. If you borrow it, you actually give away, or you give up a little bit of return that you would otherwise get.
Naturally. Yeah.
So we're probably going to move to that system or add that as an additional approach. But for launching the system, we sort of needed something that wouldn't prevent people from putting in the amount of liquidity that they wanted. So I think that we'll probably be making things a little bit more. You have a little bit more options on how you do this in the future. But for now, it's just it's a borrow and provide liquidity.
Got it. Sweet. Thank you so much for that detailed talk through.
Yeah, and so what else can we look at here? Since I've got this up, I've got borrow, got lend. I mean, the key thing to understand, of course, is you can borrow for multiple different series. So, we now have interest rates. You can see, 2.6% to borrow through March 2021, 3.61% to borrow to June 2021, and so on. When you actually go to borrow, what you'll see is, let's say I comes to I actually try to do it, and we can take a look at that. The larger amount you try to borrow, since there's a market maker behind it, there's a price impact to borrowing. Mm-hmm. So the interest rate does go up as you add more, and I'm adding by tenfold here. Mm-hmm. And you can start to see, the interest rate goes up a little bit as you add stuff. And if you try to borrow currently like 100,000 DAI worth, there's a little bit more slippage. So that's part of the impact, and you can see that APR down here.
Can you talk a bit about how the interest rate is actually determined?
Yeah, so the interest rate that's determined, it's based on the price, right? So if we go back to this market description, like Uniswap, when you want to do a larger trade, you have a little bit more price impact, right? There's the price changes against you. We just changed that into an interest rate in the user interface so that you understand, okay, here's the interest rate that I'm getting when I'm doing that borrowing. And the benefit of this constant power sum formula is that it has way less price impact than if you were to do this with Uniswap. And in fact, I can kind of jump to a slide that attempts to illustrate this. Yeah. If you were to do this in Uniswap, you'd see that you'd have this, just a small trade would do a very large price impact in interest rate space, whereas in our yield space, it's much more muted.
And that's because it's a interest rate based model and not a price based model.
That's right. Yeah. I mean, yes, exactly. The challenge is like Uniswap is designed so that it sort of spreads out the liquidity over all prices. So from 0 to infinity, which makes no sense in when you're trading something like FiDai, because the interest rate is most likely going to be somewhere between 0 and 20%. Like that's probably the highest you've ever seen in DAI. So having a liquidity from 20% to infinity % doesn't make a lot of sense.
Yeah.
Right. So we've made it more efficient by introducing this new way of trading. But actually, we've learned that we can turn it up even more. There's really even more capital efficiency that we can squeeze out of the system. So that's kind of partially in our thinking about, okay, maybe we should upgrade the pools and take advantage of that. And we're just now starting to do that work.
It's very cool. Question then, if let's say well, hold on. So a series, right? When it begins, how long is it open for? Is it basically open until the end, until like the maturity? Like, can I borrow from that series a day before it matures?
Absolutely. You can borrow it until it closes.
Got it.
Until it's redeemable. The yield space market can handle that. So even though the price gets very, very close to 1, but you still get a pretty good price in interest rate terms, even though you're paying interest for less than maybe a day or a few hours, perhaps.
Is there a cap on how much FiDai can come out of a given series?
Is there a cap? No, we don't have a cap. I mean, no. I mean, obviously, you're limited by how much collateral is placed in the system. So, obviously, the sum total of ETH limits how much FiDai there can be.
Right. Yeah, yeah, I get it. Yeah, I was meaning more like some line, like basically how the vaults at Maker have debt ceilings. I was curious if FiDai had something similar And the reason I ask is because there's like this deeper question I'm trying to understand about the interest rate is that it is like individual position specific, right? So if I borrow from 100,000 DAI and have to pay like 5 or 6%, that doesn't mean that the person after me in the series is also going to pay 6%, even though they're borrowing 10,000 DAI, but rather it really is price based on individual position and size.
Right. Yeah.
Right?
Yeah. So this price here is not the price everyone's paying. I mean, this is the price that you would get if you did this trade right now. And so it's sort of really, you know, you're locking in a rate for you. Not everybody's getting the same rate. Right. So, you know, you kind of got to check and see what's available. And it's because there's a market behind this rather than, you know, in the case of Maker, where everybody is sort of a part, or is basically trading against Maker.
Yeah. And then just one more thing. So the way that the amount of Phi DAI works is if I'm, let's say, borrowing 10,000 DAI, I get 10,000 Phi DAI, and then I have to pay back whatever it is, 10,285 DAI at the end of it, right?
Yeah. So.
Or is it that I get like 9,000 something Phi DAI and I have to pay back 10,000 DAI at the end?
I mean, I can answer that actually like right directly from this screen. So right now I'm saying I want to borrow 10,000 DAI, right? Yep. For until March 2021, and it's the interest rate that I get would be 2.85%, and what that means is that come you know, March 2021, I'm going to owe, you know, 10,055 DAI. Mm-hmm. You know, and so that's essentially how much Phi DAI I owe.
Okay, yeah, okay, that makes
55 Phi DAI.
Okay, cool, got it. That makes sense.
So yeah, so you're borrowing, you know, you in order to borrow 10,000 DAI, you're borrowing more Phi DAI than that.
Got it.
And then so you'll obviously owe that at maturity, but you know this we can calculate it. It's displayed. You know what that's going to be.
Yeah.
And
it makes a lot of sense.
Cool. So I think, you know, I'd like to next show the rate lock tool, if that makes sense. So the rate lock tool is, you know, and I'm going to move to Kovan so I can actually use it and
be my guest.
Show everyone how this works. So let me just refresh. Aha. So, okay, so here we go. So I moved to Kovan so this would be easier and faster, and you can see this. And on Kovan, I have a couple of Maker vaults I've already set up, and this is set up through you know, Maker's Kovan you know, site. So I have 2 vaults, and we tried to make rate lock very simple. And what rate lock does, it does a lot of things behind the scenes actually to achieve what this level of simplicity. But the way to think about it is, you know, if I have a vault in Maker, you know, I have some amount of ETH locked up and some amount of DAI I've borrowed. And if I want to lock in a fixed rate, you know, we can move that from Maker to yield and lock that fixed rate in, you know, in one transaction. Yeah. And that's what we're seeing here right now. So, you know, just looking at what's available, you know, if I want to right now, I guess, move it from my Maker vault to, you know, on Kovan to yield, I can do that right now. Excuse me, for through September 2021 at 3.1%. You can see here that excuse me. You can see here that I have the marginal interest rate. So you can see this is what, you know, if you're just doing a very small amount, what kind of rate you'll get. And then right here I have, okay, this is how much I would, you know, my actual vault here that I've selected will actually get. So we can go ahead and just give this a click. I need to make a signature, and then I can confirm the transaction. And that's it. Like, it's one transaction to do this, to lock in a fixed rate for this. And hopefully this being Kovan, it'll be very fast to complete. Oh, it's done. All right, great. That vault is migrated. And so now if I go to the borrow page, I can see what I've just done. I have, you know, some amount of collateral. I've moved over, as you can see it in collateral. part here. Okay, it's 9 ETH. I can see that I have borrowed, or I have my, basically the Phi DAI, the DAI debt that I made, and then the DAI or the interest I'll owe at maturity, which is 3.54 DAI. But that's in the system, and it's locked in at a fixed rate, so I can go here and just check it out. Yeah, so I've imported, looking at my transaction history, and you can see other stuff that's happened in the past. But here today, I imported, a DAI debt of 200. I brought over, 2 ETH of collateral. I did it all in one transaction.
So when the fixed rate Phi DAI position matures, and this turns back into essentially like a PseudoMaker Vault, it doesn't go, like, again, I'm trying to just jog my memory from the beginning of the call, where it doesn't go back to being a Maker Vault like purely, but it does that kind of magic that you talked about. Yeah.
Right. So when you've borrowed in yield, it doesn't, after maturity, what we start to do is we start to charge you the stability fee. So you have to start paying a floating rate after maturity. And you can deal with that by either paying back the debt and then retrieving your collateral, or you could maybe borrow some more DAI from a future maturity and sort of roll it. And we're working on some tools to make the roll process better. And in the future, also another approach that we hope to provide is letting you migrate back from yield to Maker. So we haven't completed that yet, but it's a planned sort of improvement. But in the meantime, or as I should say, a key part of the protocol is that it just treats it'll start to act like it's a Maker Vault in the yield system.
Right.
That is, you'll be charged this debt after the maturity date. We'll start to just accrue the stability fee, just as if it were in Maker. And it's easy to deal with. You can come back and basically click repay, and you can say I want to pay back 100 DAI or whatever. And easily done.
Nice.
Yeah. So we've I think tried to make it very easy. So if you have a Maker Vault today, and you can easily get into our system, we make it very easy to go back to Maker. We're really trying to, I think, really address the needs of the Maker and DAI community, and getting good fixed rates. We've really sort of worked to make these integrations seamless and make them work really well, and very useful. And there's one thing else I want to point out about the rate lock tool, if you don't mind. You can do more advanced work here. So for example, I have another Maker Vault. I can decide, I just want to migrate 1,000 DAI of debt. Maybe the suggested amount of collateral. I can. That's a lot of collateral.
So basically,
or something.
Yeah. So you can migrate a portion of your Maker Vault, even.
Yeah. I can migrate a portion of the Maker Vault. So some amount of the DAI debt, some amount of the collateral, and then I can just lock in, a rate in the same manner. So you don't have to move it all over. You can just move some of it. You can try it out. You can do it for a portion. It really is sort of up to you whatever your needs are.
Got it. So now where my mind is going is I'm thinking about an environment where, this is an environment where the Maker ETH stability fee shoots up to 20%, for example, like it did a couple of years ago. It's crazy to say a couple of years ago. Wasn't it? Sorry, I'm losing my track. Sorry, it's a little bit of a rough Tuesday for me. But so where my mind is going is in an environment where the stability fee for ETH jumps up, since this is a totally secondary unconnected market, basically the loss I'm trying to just it almost seems too good to be true that you could lock in such a rate. I mean, you are locking it in at a premium compared to the current rate, right?
Right. Well, so the rate that you get is currently set by the marketplace. Yeah. So you know, I mean, these rates, you know, I'm currently on Covant, so these rates are just entirely made up. They're because it's the test network. So I can move back to.
So they're not. Are they dependent at all on Maker rates, or they really are just free market rates?
They're free market rates. Like there's you know, and they can be kind of. Okay, they didn't get back to it yet. Let's see. Here we go. I think, okay. Yeah, so they can be kind of weird. Like you can see right now, it's cheaper to borrow through September than it is to borrow through June. And liquidity is different for each one.
Right.
So it is free market determined currently. Yeah. And, you know, I mean, you know, what could make it, I mean, or what could bring it closer to Maker or maybe provide liquidity, you know, is if something like if Maker itself were to buy FIDAI tokens, that would be one way that you could, you know, Maker could say encourage this market. Yeah, and of course, if Maker did that, it would earn, you know, if Maker was selling December 2021 FIDAI, you know, it'd be the Maker protocol earning that 4.29% rather than whoever purchases it. So today it's just a free market of you know of borrowers and lenders who are setting these prices.
Got it. Fascinating. This is really cool stuff. Yeah, I'm gonna call out to the chat. Oh, I see there was another question asked. So are these loans subject to the Maker dust limit? Do you have to borrow at least some minimum amount? 500 DAI presently is the dust limit at Maker. So yeah.
No, the answer is no. Just acknowledging the question. There is a dust limit in our protocol, but it's much lower. I think it's like fractions of a DAI currently. And there is a minimum collateral requirement. I think it's 0.05 ETH right now. So we sort of, since this protocol version 1 is immutable, we sort of picked some numbers when we launched it, which were small, but not that much smaller than ETH or Maker than at the time. But then Maker has raised the dust limit enormously, I think, over recent history.
There's even a current proposal to raise it even further. So I think the winning poll on the forums was 2,000 DAI.
You know, that makes it really expensive to test this. The rate lock product. I mean, we were like, wait, now we have to do this for 500 just to try it out. Okay.
Yeah, the beauty of testnets, though. Am I right?
Right. I see a question that I think is really good, so I want to answer it. It's what price oracle are you using for settlement? The answer is we're actually using Maker's oracles. Or I shouldn't say oracles because Maker has a set of oracles. Then they're permissioned. You have to have permission to use them. We don't use those. We actually are using something lower level. So we look at Maker's internal price, so to speak, that includes both the price and the collateralization ratio, so that we actually get both things at the same time. So we inherit both Maker's price oracle and the collateralization ratio directly from Maker. And that's necessary because, as I said, we have this settlement process where, you know, we use Maker in the back end to borrow DAI to pay off the lenders. So it was necessary for us to just sort of use the same collateralization ratio and the same oracle as Maker, so that they line up. And there's a question about, since DAI is not perpetual, how and who liquidates the loan? So the loans don't ever get liquidated in the sense that there's no day where you ever have to be like, this is the day you have to be backed by, or you're going to be liquidated. With the exception that, of course, you're going to be charged interest. You're going to be charged first, or you're going to first have to pay the interest from the borrowing. So if ETH collateral doesn't support that at some future time in terms of price, you can be liquidated. But you're also going to pay, after maturity, you're going to pay the stability fee. And so that could go up in theory over time to the point where you're liquidated. And you have to, you know, your Yield Vault is sold off in an auction. But those are the two constraints. Like beyond that, you know, it can stay open indefinitely. And you know, this is a smart contract deployed to the Ethereum blockchain. We don't really have a way to change it. So they're in one sense, you know, it'll just maybe indefinitely stay open unless you come back and pay it off and retrieve the ETH.
Right. Going back to the Oracle price that yield reads, if it's not through the permissioned Oracle, I know the permissioned Oracle getting whitelisted and all gives you like a far more direct line to those published reference prices.
Yeah.
So what exactly which value where is being read by yield is what I'm curious about.
I mean, so this may not mean anything to people who aren't like familiar with the internals, but I can give you an answer. So the core of the Maker system is a contract called the VAT.
Yep.
And inside the VAT, there is I'm forgetting what the exact name of it, but basically the VAT keeps a record of what for every collateral, what is the price of that collateral times the collateralization rate. So it basically tells you the amount of collateral that a person must maintain for that you know, for those kinds of positions. It's in the VAT. I think it's called like VAT ilk something, and it you know, we just sort of read that directly from the Maker protocol. I mean, we looked at going through the permissioned oracles, but and that would have been a great approach. And I think that the permissioned oracles that Maker have are a really great product and a really good setup. It just for what we needed, we actually needed both of those things.
Yeah.
So it really made it easy. It made sense for us to actually just inherit them directly because we needed both of those. In fact, there's no way to actually. I don't think we could figure out a way to get both of those and then combine them in a way as good as just reading that number directly.
That's so interesting. Cool. Yeah, I'm really excited where this project is going. It sounds like some really key first steps for like a proof of concept have happened, and I'm curious about basically what's next, and also a little bit more detail about the team. I'm curious how many people are working on it and kind of what the path for growth is for you guys.
Well, we're a small team. So I'll answer the team question before I talk about what's next.
Sure.
Just to bookmark that. And so right now we have one full-time smart contract person, engineer. It's our lead engineer. Then we have one person who's working full-time on the front end. And then we just have a lot of, you know, other people that have been sort of helping in different capacities. So some of our investors from Paradigm, Dan Robinson and George Yost over there have been helping out and helped get version 1 out the door. We've had some contractors in the ecosystem who are familiar with, you know, things that we weren't quite as good at. So for example, there's a wonderful consultancy called ABDK who do incredible work on math in Solidity and have developed some great math libraries, and they helped us build some of the really interesting math tools that we needed that didn't exist to make the yield space market. Yeah, and then just, you know, a few other contractors who are sort of helping with the protocol. But honestly, it's really just 3 full-time people at the moment, and we desperately need more help. You know, smart contract engineers, front-end engineers, but also, you know, I think ultimately we need help, you know, from community perspective, from, you know, business perspective, and things like that. So, you know, if this is a really exciting project to anyone watching, you know, hey, reach out to us. We're looking to grow, and we're looking to try to make an impact. So that's the team, and then to talk about future plans. I mean, we're always kind of thinking about that and reevaluating, like, what should be next. How do we basically best serve the community? we thought we started with this version 1, targeted towards DAI, which we thought had the most acute needs and would be most interesting. And then we sort of had this idea that, after that we would do a version 2, and we would, potentially look something more like Compound, where maybe we have, excuse me, lots of different types of collateral, and then lots of different assets you can borrow and lend. And we've really sort of actually found ourselves sticking closer to DAI and to Maker, and finding more and more ways that we can build closer to Maker and integrate better with Maker. Just because, I think that we like the vision, but also we just sort of see that need as being so central to DeFi, and the things that Maker has been doing so important to DeFi. So we're thinking about, like, how do we actually even move even closer to Maker, and that's partially things like rate lock, but also maybe there's some way that Maker, we can integrate with Maker or work with Maker, to support this sort of longer term lending, fixed rate markets. So we've sort of been thinking about that, and are kind of working on, like, okay, is there a Maker improvement proposal here where maybe Maker buys FIDAI or something, or adds it as a collateral type or something like that, so that we can unlock some of these things for users of Maker, and make it more valuable to them.
Totally. Yeah, that's really, really great. Yeah, I'm curious more about the reasoning for moving towards Maker versus Compound, for example.
I mean, the reasoning that it's not like some really super deep thing. It's just like, I come and I look every day and I'm like, how is Maker doing? How much DAI is out there? Like how much collateral is being borrowed? And I just see this number go up, all the time. Like, people are using Maker, they like DAI, they find it valuable. And, when I see that, I'm just like, okay, how can we, that seems valuable. How can we serve that community? So that's sort of really what's driven our thinking about that.
Couldn't you say the same thing about Compound, though?
I mean, you certainly could. And in some level, their interest rates have been, more volatile, in the sense that their DAI rates are really high. But I think that it's sort of a thing, is like, do we, we're thinking long term, are we going to go that direction? Maybe go and try to, like, appeal more to yield farmers, or do we want to, like, work more on something that could be closer to what Maker's doing, and just sort of be more fundamental infrastructure to the ecosystem?
Totally.
That's not a perfect representation of the trade-off or the thinking there exactly, but it's kind of how I, like, roughly think about it. And we're I think that, like, I'm trying to, like, I want to build something that like lives past maybe some of the madness with yield farming. And so, I want to make sure that we're getting right the fundamentals. And so I feel like if we can really make yield protocol work well for DAI borrowers, then I think maybe then we can go do those other things and do it well. But if we can't get it right, I don't think, for DAI borrowers, if we aren't figuring that out right, then we could go to do those other things and maybe, not have an impact, just because, you haven't really solved the fundamental problems. You haven't figured out how people want to use it. You haven't really tried to, like, dig in and to the challenges and make it useful.
That's such a huge parallel to exactly what's happening at Maker with DAI, for example, because over the years, so many people have said, when Euro DAI, when CPI DAI, and, like, all these other, like, versions of DAI, and the answer really has been, we're trying to figure out the nuances of doing one before we go on to do all the others.
And I think that served Maker well, in the sense that, we're seeing, if you were, when there was 100 million DAI, if you started going and doing all those other things, you probably wouldn't have done the things, or has been as focused on the problems that have let you get to, a billion DAI issued.
Totally.
And the way that you think about that will affect, how do you get to the 10 billion DAI issued. And I think that's kind of a very much how I think about it, which is, trying to maybe avoid the hype a little bit. How do you build like really good tools, and how do you make sure that you're building something that people actually sort of want to use, actually solves their need? So that's very important to me.
And fixed rates are a really, really, really huge deal, because floating rates, they're hard to hedge against. They're hard to predict. There's just like an inherent level of risk there.
Mm-hmm.
Of course, you have like that unlimited term, but for the trade-off of having a fixed term, now you have a far more certain risk measure when you're like doing portfolio math and stuff like that, and managing a fund or whatever it might be. Yeah. Having a control over the rates on your debt is really important.
That's absolutely true. It's tricky. I'll say one thing we've learned about with doing yield protocol is it's tricky right now, sort of navigating fixed rates, and I'll explain why. You have on one end lenders who are looking to make a return, right? And so if you compare their options right now, they could go to yield protocol and put in, lock in at a rate of, I mean, somebody's willing to put it in and earn 2.8% right now, but the liquidity depth is not huge.
Yeah.
But you could do that, or you could go earn 15% putting into Yearn. Conversely, when you're a borrower, you could borrow right now at 2.5%, I believe, on Maker, which is going to go up to 3.5%, I believe, this week.
Yeah, surely. Yep.
But that's a big gap, between borrowing at 3.5% at a floating rate and earning 15%. So it's a real challenge, I think, right now to square that gap from the perspective of fixed rates, because there's it's just such a mismatch between where borrowers and lenders are, given the weird dynamics of the ecosystem. But I actually think that actually, there's ways that like we can actually, fixed rates actually help fill that in. Because, for example, if Maker were to start buying FiDai, you can tell what I've been thinking about lately. It would let Maker target longer term rates, and provide liquidity there. So actually, some of that, I think, some of that difference between the where Maker is at in terms of stability fee today versus where people are earning rate of return, that could be filled in by longer term fixed rate loans and by Maker lending in that.
Yeah, I totally agree with you, and it's a really exciting future to think about. I totally see a world where Maker as a protocol would hold something like FiDai on a balance sheet and use it. Yeah, totally. I know we're about a minute from the top of the hour, but I know Frank had one more question that he had written in the chat.
Sure. If you don't mind, I'll just read it. So Frank asks, how did you pivot when the DSR was turned off? And one of the articles you wrote, if you own FiDai after maturity, you will start to earn the DAI savings rate on your FiDai until you decide to redeem it for DAI. That is still true. The thing is that the DSR, I mean, we didn't change anything. The DSR just went to zero. So, right now, if you're holding FiDai after maturity, you're earning the DSR. It's just zero. So it's not impactful.
So you didn't pull a compound and unintegrate it or deintegrate it, right?
No, and then, as I said, we can't. Like for version one is sort of is fixed and is going to stay the same indefinitely.
Cool. Yeah, thank you so much. And I guess one question to send you off with, ETA for version 2?
To be determined.
Fair enough. Well, this was a really, really fascinating call, and I'm excited for the potential that Yield Protocol has. And ever since I read that Dan Robinson paper all those months ago, I knew that there was some really, really interesting stuff that could go on with these kinds of tokens and this kind of like design. So thank you so much, Allan, for coming on the call again. I really can't wait to have you on in like a year or something from now, and we could talk about the whole next progression of Yield Protocol.
Yeah. I hope even sooner than that, and I appreciate you having me.
Same. Well, cool. Thank you everybody for joining, and yeah, this will be posted to YouTube later today.
Thanks everybody. Bye.
All right. Bye.